A very good afternoon to everyone. I am Shanavas and I'm a corporate trainer at Fintu, and I welcome you all to another webinar hosted by Fintu. And to introduce Fintu, Fintu is a fee-based wealth advisory firm based in Mumbai. We provide end-to-end financial services to our clients in the field of financial planning, investment management, tax planning, estate planning, and will planning. We have served over 1 lakh plus clients not only in India but also abroad. And now let me introduce to the speaker for the day, Ms. Nidhi Manchanda. She's a certified financial planner with a decade of experience in training, development, and coaching working professionals in managing their finances. The topic for today's webinar is Expert's Guide to Invest in Gold, where we learn how you can invest in gold, what are the different options to invest in gold, and we'll do a comparative analysis of each option. So over to you, Nidhi.
Thank you, Nawaz, and a very good afternoon, everyone, to today's session. So I'm sure that every one of you are already aware on what topic we are gonna discuss today. It's all about gold, and as wedding season has started, I think many of you would be thinking that we would be buying gold and maybe gifting your loved ones with gold. So in today's session, we'll actually see the gold outlook, how the gold has been performing till now, what's the future outlook for gold, whether you should be investing or not investing, what are the different ways that are there for investment. And yes, we'll see the pros and cons as well. And also I would suggest that if you have any questions, any queries, feel free to put that in the Q&A box and I'll definitely take it up from there towards the end of the session. So I'll just share my PPT now. Just give me a second. Is it visible? Nawaz, can you confirm, is the PPT visible?
Yes, Nidhi, it's perfect.
Okay, fine. Okay, so we'll be talking about most effective ways to invest in gold, and like I mentioned, that we'll be starting with basically the gold outlook. So before we directly jump into what are the different ways that are there for you to invest into gold, I would like to give you a little bit brief on the overall outlook on gold investment. Now here, if I talk about gold, first let's start with international prices. So if you talk about globally, since beginning of this year, gold has given a return of around 2.23%, and this is majorly because of the surging dollar and rising interest rates. Now we all know that the inflation is a huge problem globally, and just to get inflation under control, all the central banks, they are basically rising the interest rates. So that is what is happening, and that is what will happen in coming months as well. And inflation, we see that's all-time high in most of the countries. Although it has been moderated quite a bit recently, but if we see the broader picture, it's still very far away from the central bank's target that we have. So this is, what we can see on a global front. But if we talk about, on the other hand, on the domestic front, the domestic gold prices, this year starting, again, the Jan month this year, from the domestic front, we can say that here the returns has been around 5% till date. And that is again based on because of the weakening of rupee. That is what is happening, and there is a steady demand. The local demand is there. That is what is supporting the gold overall. Talking about outlook in India, India's gold demand has reached the pre-pandemic levels. If you talk about that, it's, it has witnessed an annual growth of 14% during the quarter ending September, which is at around 191.7 tons. In value terms, also gold demand grew by 19% to 85,010 crores. And if I talk about jewelry demand, now we all know that India is the second largest consumer for gold, and the majority of it is in the form of jewelry. So the total jewelry demand in India during the third quarter increased by 17% at 146.2 tons. It is compared to, the same year last year, it was around 125.1 tons. So it has increased there also. And the major reason for this is credit expansion, which is adding impetus to this demand, with bank loans growth touching a 9-year high by quarter end. Now, looking ahead also, if you look at the perspective, I think, very well we understand overall globally, and if you look at the domestic prices of gold as well, gold has not been performing that great as per the expectation, although we have seen that whenever, there's volatility in the equity market, gold has been outperforming. But this time, this year, it is actually, outperforming, but it's not at that level which was expected from that. And there were a lot of other reasons behind that as well. But going forward, we believe that, it will continue to benefit from a safe haven perspective. When we are investing into gold, we should be looking more of it as a diversifier in a portfolio rather than from returns perspective. And that is what, we suggest to invest in gold in that manner as well. We'll discuss that more detail, when we come to the later slides. So amid this rising interest rates and weakening of rupee, this is what the outlook is for gold right now. And another point to add here is that the RBI purchased 17 tons of gold last quarter and bringing the total gold reserve to around 785 tons now. Talking about the overall picture, the question that comes that, has the gold started shining? We can see the graph already. It's, that it's you can say a little volatile lately. But there are certain factors which are supporting gold demand and the prices of the gold. And that is the reason where you should be having certain exposure to gold in your portfolio. This could be, the first, as you all are aware about the geopolitical concerns over Russia and Ukraine war. So we are in the midst of a war that is going on. High inflation scenario that we just discussed. Equity markets are very volatile and the valuations are also very expensive, and we have seen a lot of volatility in the equity markets. And like I mentioned, gold and equity markets are inversely related. So, as a hedge against equity, we usually invest into gold to diversify our portfolio. Also, there's been, I think everyone is aware that, there's a fear of recession in the next year or next, few months. We are expecting that, there will be a recession. So again, in such a scenario, gold will be something which will, come out as a traditional form of investment, or maybe if you're investing gold in online, that is something which will draw investors' attention. It is treated as a safe haven metal, inflation, hedge against inflation. And like I mentioned, to diversify your portfolio, it's really important that you have some exposure. But like we have discussed so many reasons and why it was not even performing, for the couple, for this year and the last year also. In that sense, it's very, very crucial that you do not be overweight in your gold investment. So there has to be very restrictive portion that you should be investing into gold just for the purpose of diversifying your portfolio, and not look at it more from the wealth generation or returns perspective. This is something which one should keep in mind. If you have any questions or queries, do let me know. We'll definitely discuss on that part. Now, moving on to the different ways that are there to invest into gold. Now, there are a couple of ways here, and we will do a comparison of these different ways that are there. So let's say we talk about the first one, physical gold. I think everyone understands this, then, and mostly in India, people are more prone towards, they are more inclined towards jewelry. So physical gold is that only your jewelry or, ornaments that you are buying, your bullions, coins. Physical gold is something which you can, touch. Second is gold exchange traded funds. Now, this is a way of investing into gold online, where you can, invest into gold exchange traded funds, where it is traded on the stock market, high liquidity you will get here. Next is gold mutual funds. It's similar to gold ETFs, but again, there are certain advantages that comes in gold mutual funds, where the fund manager is investing your money into these ETFs itself. So that is one way, indirect way of investing into gold. Then comes the sovereign gold bonds, again, the paper form of the gold. And these are the bonds which are issued by RBI on behalf of the government. So you have a sovereign guarantee when it comes to sovereign gold bonds. And the last one is a digital gold option. So that is also one of the option if you want to invest into digital gold. Again, these are the 5 options that you have that you can invest. Now moving on, if I talk about, I would want to give you a point-to-point comparison, like looking at one of the features, how each of these 5 pair in that. So let's start with that part as well. So if you have any questions, feel free to put. So once I'm just done explaining the comparison, I'll just start with the questions directly. So again, the comparative part. Like I mentioned, there are 5 different options we are talking about and discussing right now: physical gold, gold ETF, gold mutual fund, sovereign gold bond, and digital gold. Now, talking about the first thing, demat account. Now, demat account, only gold ETF is an option where you would need a demat account to invest. Apart from that, no other option will need a demat account to invest. But I would feel that even if having a demat account would not be a limitation to invest into gold ETF, because in the last 2 years, we have seen demat accounts rising, very rapidly. Specifically, we can say currently if there are around 10 crores demat accounts, 50% of that has been opened in last 2 years, post 2020 itself. So there's increased awareness among people to start investing. So I don't think so that will be a challenge, but still I would want to make it clear. For gold ETF, you need to have a demat account, but rest of the options, you can do it without the demat as well. Now, talking about the purity of the gold, when you're investing, how it is. Now, if you're investing into a physical gold, if it is a coin or it's a bullion or it's a jewelry, we all understand that purity you can't be 100% sure of. It depends upon from where you are investing, where you are buying that gold from. But when it comes to gold ETF, like I mentioned, this is online. So purity is not an issue. It's 99.5% purity gold where the money is invested. Coming to gold mutual funds also, like I mentioned here, the fund managers are actually investing your money into gold ETFs and their exposure. So similar underlying assets, so no issue of the purity there as well. Sovereign gold bonds, government guarantee, it's a sovereign guarantee that you're getting. So again, this is also 99.9% purity that it comes with. And digital gold also, because you're not actually getting the physical gold, you are doing it online. This also comes with a purity, this thing. So there is no purity issue here as well. So only when you're buying a physical gold, it might be an issue. Otherwise, other options are fairly good on the purity terms. Talking about the charges. Yeah, so let's talk about charges here. This is very, very crucial to understand. When we talk about physical gold, it has a lot of charges, and the main thing is your making charges that could be as high as 20 to 25%. Now it varies from actually where you're buying, so you will have to check that it's not regulated as such. But that is how the expenses will be there for the making charges. And there are a lot of wastage also when you're making a jewelry and you're buying in the jewelry form. Coming to gold ETF, here the AMC fees and brokerage will be charged, which will be close to 1%. Mutual fund is also, you will have an expense ratio. So any other mutual fund, like different categories of mutual fund and expense ratio. Similarly, for gold mutual fund also, there is a expense ratio, which is close to 1.5% there. Sovereign gold bonds, again, it is actually the best among all 5 if you talk about the charges, because here you do not have any charges. You can directly invest into sovereign gold bonds. Digital gold, on the other hand, it has additional charges there. Again, it has some storage charges, insurance charges, trustee fees, which cumulatively, if we think, it can go up to 3 to 4%. So that is how your charges are. So if you just look at the charges part of it, sovereign gold bonds will be the first one, and the second preference would be gold ETFs or gold mutual funds. Okay. Now talking about the physical delivery. Now, if you want to invest into gold because you would want some jewelry, I would suggest that only the bare minimum which you would actually wear you can actually go for a physical jewelry, because if you want to wear it, then any which case you will have to buy a physical gold only, the jewelry that you want. But for the investment purpose, don't invest into physical gold, because again, there are a lot of disadvantages that we are seeing right now. Now, physical delivery, yes, in physical gold you can get it. In gold ETF also, you can opt for a physical delivery, but it comes with a certain conditions. There's some cap over there. But yeah, in certain conditions, you can actually get a physical delivery. But I would suggest, if you're investing into gold for the investment purpose, you should not be bothered about getting a physical delivery as such. It is more about, the hedging purpose that you're diversifying your portfolio and the returns that you're getting. Gold mutual funds, sovereign gold bonds, you will not get any delivery as such. Digital gold also, it depends, from where you are investing into digital gold. There are different platforms. So somewhere you will get the delivery, somewhere you will not get the delivery. Somewhere you'll be forced to get the delivery after a certain period of time. So it depends from case to case. That is what is for physical delivery. If you talk about risk of theft, now, gold, there are 5 options. I think this is very simple to understand, that physical gold is riskier to hold at home. So, other options are quite safe. Talking about liquidity, all the options are highly liquid. Gold ETF, it's trading on the stock exchange anytime, like how you buy and sell stock. Similarly, you can do for gold ETF as well, highly liquid. Gold mutual funds also are liquid. Even gold, physical gold, you can actually liquidate it easily. Sovereign gold bond is not very liquid. So if I talk about liquidity, and you are looking out for an investment for a 2-year or a 3-year time period, short term, medium term, in that case, I would say then you should not be investing into sovereign gold bond. Here, the lock-in period is for 5 years. The actual tenure for sovereign gold bonds is 8 years. So if you hold the bond till maturity, it's an 8 years time period you need to hold it. After 5 years, you get an option that you can sell it on the stock exchange. But again, it comes with a disadvantage. I'll tell that, in a later part. The taxation disadvantage comes if after 5 years you sell your bond. But apart from that, other options are highly liquid. So if you're looking out for liquidity, I think gold ETF and mutual fund will make more sense. Otherwise, sovereign gold bond, you can look out for long-term investment. Now, talking about the minimum and maximum investment. Physical gold, there's no limit as such. Although, if you're wanting a coin, there will be a little bit, there is minimum or a maximum part, but again, it depends. No maximum minimum limits as such in physical gold. Gold ETF, 1 unit you can invest into gold ETF, and that 1 unit is equivalent to 1 gram of gold. Maximum, there is no limit. For mutual funds also, 500, 1% you can start investing. Maximum, there's no limit. Sovereign gold bonds, 1 gram is the minimum and 4 kgs is the maximum for one individual in one financial year. Digital gold, minimum you can start investing by 1 rupee. I think that is what is being marketed a lot, that you can start investing into gold as low as 1 rupee. Maximum, again, there is no limit as such. Another point I would like to highlight here, difference between gold ETF and mutual fund. If you're investing into gold ETF, you won't be able to do an SIP as such, because again, on a monthly basis, if you're someone who is more comfortable investing into gold on a monthly basis, then I would suggest go for gold mutual fund, where you have that option of doing an SIP in gold mutual fund and taking that exposure on a monthly basis. In gold ETF, you will have to do a lump sum investment itself. Talking about returns, returns here, terms of whenever you're investing into gold, you get some capital gain. So at a price where you have invested your amount, after a certain amount of time period, the gold has appreciated and you have the certain amount of capital gain that you're making. This is something which you will get in physical gold. You will get this in gold ETF. You will get this in gold mutual fund. You will get this in sovereign gold bonds. You will also get this in digital gold. So gold appreciation that is happening, that return you will get in all the 5 options. But in sovereign gold bonds, you will also get a 2.5% interest, which is over and above the capital appreciation that you're getting. So I would say, for this reason, it has an added advantage when you are investing into sovereign gold bonds. So very important thing, sovereign gold bonds, 2.5% additional interest that you're getting. Coming to the tax part. Now, when you're investing into gold, you will have to check whether you are making short-term gains or you are making long-term gains. Now, how you will make short-term gains and how you will make long-term gains will depend upon your holding period. So holding period in case of gold, now every capital asset has a different holding period definition as per Income Tax Act. But for gold, this is 36 months. So if you are holding your gold for less than 36 months, you are selling your gold investment in less than 36 months, less than 3 years, and whatever gain that you make in that, when you're selling it, that's called a short-term capital gain. But if you sell your investment after holding it for 3 years, then what gain you get is called as long-term capital gain. Short-term capital gain will be taxed as per your slab rate. So if you're in 5% tax bracket, 5% tax, or if you're in 20% or 30%, whichever tax slab rate you are in, that much tax you need to pay here in short term. But when it comes to long term, you will have to pay 20% with indexation benefit. Now, indexation benefit is nothing but you will get the benefit of inflation. Okay, so 20% not on your entire gain, but only on the indexed value of it. So I'm assuming that you are already aware of that, but in case someone has some confusion on indexation or how the indexation works, do let me know in the Q&A. If you want me to explain that in detail, I'll definitely take that up. So that's the difference. Short term as per the slab rate, long term 20% with indexation benefit. This is a taxation for all the options, all the 4 options except sovereign gold bonds. So sovereign gold bonds, as you can see it on the screen itself, at maturity, after 8 years, when your sovereign gold bond matures, whatever amount that you receive is exempt from tax. You do not have to pay any capital gain tax on sovereign gold bonds. Coming to the other thing, interest that you're getting, 2.5%, I mentioned that additional interest that you get in sovereign gold bonds, that is taxable as per your slab rate. So that's not tax free. That 2.5% is taxable. But again, the major advantage here is if you are investing for a long term, if you are an investor who are looking out for gold investment for a long term and you can hold your investment for 8 years, then I would suggest that go for sovereign gold bonds, because then on maturity, you will not have to pay any capital gain tax as well. So this is one. Now talking about GST, we have talked about income tax. So GST also we should see. When it comes to physical gold and digital gold, you are supposed to pay 3% GST as well. So added cost. In all other 3 options, there is no GST at all. So 3% GST in physical and digital gold. Also in physical gold, if you are going for jewelry, so there will be some making charges. On making charges also, you are supposed to pay GST of around 5%. So that is the charges there, GST part. Availability, I guess availability is not an issue for most of these options except the sovereign gold bond. So like for currently, if I'm talking about sovereign gold bond, there's no issue open right now. So whenever RBI comes up with an issue, you can subscribe and invest into SGB bonds. So at any time, you will not be able to invest. So that's a little limitation in terms of sovereign gold bonds. But for all other options, whenever you want to invest, you can actually, go direct and invest there. Talking about regulator, so physical gold and digital gold are not regulated as such. It's an unregulated market. But when it comes to gold ETF and gold mutual funds, these are regulated by SEBI. Sovereign gold bonds, like I mentioned, this is issued on behalf of the government by RBI. So sovereign guarantee is there. So it's by the government itself. So that's what the advantages are. So I think it is, clear understanding is there that there are 5 different ways that you can get exposure to gold. And when it comes to exposure to gold, we can see there are somewhere there are pros and there are cons. But at the end, a question would come to your mind that, where should I actually invest my money? So what is the recommendation from our side? I will divide this recommendation in 2 parts, talking about short-term and long-term investments. So in case you are someone who would be investing into gold for short-term. Now, when I say short-term, just for this recommendation part, I am saying that if you have an investment horizon of less than 8 years, I'm treating that as short-term for this particular understanding. So if you are investing in gold for a term which is less than 8 years, I would suggest you go for gold ETF or gold mutual funds. Go for gold ETF if you have a demat account and you don't need, you do not want to do an investment through SIP, then you can go for gold ETF. Otherwise, if you don't have a demat account, then you can go for gold mutual fund, and you also can do investment by way of SIPs as well. But on the other hand, if you have that 8 years time horizon in hand, then definitely sovereign gold bonds is something which you should look at. And when I talk about sovereign gold bonds, there are two major advantages there. First, you get an additional 2.5% interest apart from the capital appreciation. And second, if you hold it till maturity, the capital gains tax is exempt. So you do not have to pay any taxation. But if, let's say, after 5 years, when the lock-in period is over and you take out your money, or in the stock market, in the stock exchange, you actually sell your investment, then whatever capital gains you get will be fully taxable as per the thing that we have seen: long-term, short-term as per slab rate, long-term 20% with indexation. But if you hold it till maturity, then you do not have to worry about the capital gain tax. So that is a recommendation from our side in terms of gold, and treat this as a diversifier in your portfolio rather than, generating higher returns. This is something which I would suggest. And one more important thing, I'm just, like I said, treat it as a diversifier. Suggest that have an exposure to gold in your portfolio, not more than 5 to 10%, to diversify, to hedge against inflation, to invest into an asset class which has an inverse relation with the equity markets. We understand that the equity markets are very volatile right now. So in order to protect you from that downside risk, a little exposure to gold is recommended here. 5 to 10% is something which you should be looking at. I hope this part is clear. Now, talking about the diversifying part of it, like I mentioned, if you can see this table. Now here, it says that there is a 10 years data starting from 2012 till 2021, the last year. Every year, you can see the best performing asset class and the worst performing asset class. So let's say if we talk about 2012, mid caps were outperforming, and T-bills or corporate bonds, you can say the debt was, the least performers in that year. But in 2013, you can see that the mid cap is given a return of around minus 5.73%. In 2014, again, small cap for the asset class, which was, the best performing asset class. So every year, your best performing asset class will differ. Sometimes it happens that we are after understanding and getting to know which will be the asset class, which will, be the best performing, and I'll invest my money into that asset class. If you're trying to do that, it's very difficult. You won't be able to do that, and you will just, be chasing returns. And in that scenario, you will not be able to generate returns as such. So as you can see in this table, the best performing asset class keeps on changing. It's not constant throughout. Also, the ones which are the best performing in 1 year, the second year, they are not the best performing in most of the cases. So, even if you talk about, let's say the first example, only if I take, in 2014, small cap was, the best performer, but in 2015, it was, somewhere around 6%. The next year, it was 1.77%. Same way, if you see the gold also, in 2012, the gold has given a return of 12%. But later in next 3 years, it was the least performing asset class with minus 18%, 2% and minus 8% returns. But then again, it started getting its shine at 11% in the year 2016. And again, you can see in the year 2020, because of the COVID pandemic, we have seen 27 to 30% returns in 2020. But again, last year was not that performing. Now, if you feel that, just because a particular asset class is not performing, I will not invest into this, then the moment it has performed and given the returns, you will lose that time period as well. So because no one will be able to actually, time and understand that this will be the asset class which will be performing better, or, outperforming all other asset classes. So the best strategy would be to diversify your investment across all asset classes to get the best out of your investment portfolio. This is something very important, and this is something which you should keep in mind while checking your portfolio, designing your portfolio for achieving your long-term goals. I hope this is clear. And with this, the little part that I wanted to share with you all. So this was it from my side. But yes, I'm open for questions. So if you have any queries, any questions, do let me know. I can see some of the questions are already there in the Q&A box. So I'll take it up, few of the questions from there. But in the meantime, for others also, if you still have any questions, feel free to type in. Till that time, I'll take these questions. So this question is by Shahzad. He's saying, what percentage of gold should be in my portfolio? So Shahzad, like I mentioned, have around 5 to 10% of exposure to gold. Not more than that, but this much is required. Like I mentioned, this is for hedging the inflation, hedging against volatility in the equity markets. And as a diversifier, it's important to have exposure this much. So to have some cautious approach towards your investing strategy, have 5 to 10% exposure towards gold. Next question is, please explain about indexation. So Komal is asking this question. Yes. So indexation is basically, I'll tell you, I'll take a very simple example to explain this concept. Let's say when you invested into gold, I'm just, taking that numbers, don't take it very literally, just for the understanding. Let's say if I talk about inflation, anything that let's say in the 2010, if something which is available at 100 rupees, now that same thing is available at 110 rupees, for example. So 100 has become 110. That is the inflation effect that I have. Now, when the things were available at 100, at that point of time, when I invest into gold, I'm getting certain amount of my investment. Now my gold investment has become, let's say 150. Now, if I have invested 100 rupees in gold and now it has become 150, I'm getting a capital gain of 50 rupees. 100 has become 150, so my gain is 50. Now, ideally, if your gain is 50, you need to pay tax on 50 rupees, like 20% on 50 you need to pay. But what the indexation benefit says that although your 100 rupees has become 150, but inflation was also there in this time period. So with inflation effect, your 100 rupee value has actually become 110. So you need not pay tax on the entire 50 rupees, you pay tax on the 40 rupees only. So I'm taking this a smaller example, but let's say if the tenure is higher, it might happen that because the inflation was high, you do not have to pay any tax. That situation can also come, or because with the indexation benefit, the taxation part will be very low. Let's say your 100 has become 150 and inflation was also in the similar range, then you will not have to pay anything. Or with inflation, your 100 has become 140, then on the remaining 10, you will have to pay taxation at 20%. So, in very simple way, I try to explain this, but let me know if you have any further query on indexation part, Komal. I'll be happy to explain it again also. Another question is, can you purchase SGBs as a gift for a friend? If so, how? Okay, so this is from an anonymous attendee. See, whoever has asked this question, you can invest into SGB bonds yourself. What you can do is, if you want someone else that, for your friend, you want them to invest into gold, you have to guide them so that they invest into sovereign gold bonds themselves. But you cannot invest yourself and, gift it, to someone else. That will not be possible as such directly. Okay, another question by Sansaka. Why gold price is different from city to city, even shop to shop in a particular locality? See, that is why, because of the physical gold. See, basically it depends upon demand and supply. So if there's more demand of gold, whoever the shops are there. So basically it depends upon if there are more people, who are demanding gold. They would specifically, you must have seen that during festive season, because many people would want to invest into gold, or during Dhanteras or during wedding season, the price of the gold increases because of that. So that depends, because that's basically the demand, because of the demand factors. After 8 years of maturity, how do we redeem SGBs? What if the gold rates are lower at that time? Can we choose to hold and sell only when the rates are high? Very good question this is. After 8 years of maturity, basically it's similar to how your bonds are redeemed, So once 8 years are over, your bonds will be redeemed. It will be, the money will get back into your bank account. You cannot postpone it. So the next part of the question that you have asked, that if you want to still hold it, you cannot, because after 8 years, your bond is matured. You cannot continue to hold it. And if the rates are lower at that time, that is what your gold investment is. That is what we discussed in the initial part of the session also. Whenever you are investing into gold, be it physical gold or be it gold ETF or gold mutual funds also, it depends upon, you know, the capital gain. So like I mentioned, I've showed you the table as well. Not every year gold is performing. And you should always see gold, you know, from a zoomed out perspective, because if you see a very short time periods, you will see, you know, in some years, you know, gold might have given negative return, or maybe in some months, the gold has given a negative return. And in some months, they would be in single month, the gold has given, you know, 20-25% return. But, you know, in a long-term perspective, it pans out. So if you see that way, gold has given around, you know, 9%, 8 to 9% return on an average, if you look at a 10-year, 15-year average that way. So looking at that, you should be investing, and like I mentioned, 5 to 10% exposure is, you know, good enough for now. Ritesh is asking, I want to know slab rate taxation means on sovereign gold bond. See, sovereign gold bond, like I mentioned, if you are holding your investment like till the maturity, like after 5 years, if you are not selling, if you are holding it till maturity, there is no capital gain tax. But if you are selling it after 5 years, then there will be capital gain tax. When I say slab rate taxation, it is your income slab rate. So let's say income slab rates, how they are, up to 2.5 lakhs, it is nil. A person earning an income in a financial year up to 2.5 lakhs, you do not have to pay any taxation. If the income is between 2.5 to 5 lakhs, then it is, you know, 5%. But again, you get a rebate there. So, you know, technically it becomes nil only. But if your income is around 5 to 10 lakhs, then 20% bracket you come into. And if your income is more than 10 lakhs, then 30% tax bracket you come into. So these are the income slab rates as per the Income Tax Act. So in the short term, whichever slab rate you fall under, you will have to pay tax at that rate only. So basically you have to check in the entire financial year how much income you are generating. That income is coming in with slab, that much tax you need to pay on your that income as well, and even on the income that you're generating through your this sovereign gold bonds or any other gold investment. Can we see the last slide once again? I'm not sure when you asked for it, but I'll just keep the slide here. If you have any question, let me know. How to track gold price when it's up and when it is down. So Saurabh, basically you can track, you know, MCX gold. That is the index that you can check whether the prices are going up and down. Even if you know, reading newspapers, there's a small, you know, column, you will be able to see it's going up and down. Every day you can track the price if you're someone who's interested to track it that way. For gold internationally, again, you know, online you can check for international gold prices, where you know, currently it's around $1,700, $1,750 it is going on. So I think the information is easily available if you want to track the gold prices. How to ensure purity of gold while buying physical gold? What precautions to be taken? See, it is very difficult to answer this question, Manish, because it actually, you know, when it comes to physical gold, it is very unregulated. So it actually, what I would suggest, you buy it from a trusted source, you know, from maybe, because again, I will not know that, you know, from which state or, you know, which place you are from, but just ask your, you know, family, friends, you know, where they have a good experience, where they have got the gold. You know, you can always, you know, once you buy it, you can also get it checked at multiple places, you know, the purity. You know, if you can see some discrepancy everywhere, it means, you know, where you bought it from has, you know, made some mistake, or the purity was not at that level. So you can do that as well. But that is a challenge of, you know, actually investing into physical gold. And that is why I would suggest, if it is not the jewelry, it's not for the, you know, your consumption basis, the wearing part of it, for investment purpose specifically, you know, try avoiding investing into physical gold, because again, you also have to pay a lot of making charges, a lot of wastage, you also have to pay GST. So investing point of view, it will not make much sense to go for physical gold as such. If I want the gold in physical form, what is the best way to invest in gold, excluding the physical form of investment? See, if you want to invest into physical, you can invest into physical by investing into gold. You know, if not, like you're mentioning, not exactly the physical form. Like I mentioned, in gold ETF also you can invest into, where you can ask for the delivery, but again, it comes with a high cap. Usually, only if you're investing, around a kg or so, then also only you can get the physical delivery. There are certain conditions there. But apart from that, if you actually want to hold a physical gold itself, then physical gold is only the option. The next best alternative for that would be the digital gold, where there is no risk of theft or the storage and all that problems will not be there in digital gold. But although in digital gold also you'll have to pay GST and everything, there are a little higher charges. But if you want to invest into physical gold only and want a better alternative than the jewelry and the physical one, then in that perspective, digital gold is something which you can look out for, but you will not have gold in your hand immediately. Only when you sell it, you can ask for the physical delivery of the gold at that point of time. Another question we have, is there a difference between one gold ETF fund versus another, and if so, why? See, in most of the cases, if you talk about gold ETF funds, it's more or less the similar funds are only there in gold ETF category. There's not much of a difference, but always when you are investing into gold ETFs, you can always check the past performance, because different AMCs will have these funds. You can check the performance, and based on that, you can invest into this. I guess we have answered almost all the questions. So thank you so much, everyone, for being there till the end of the session and asking your questions.
Nidhi, I guess there is one more question by Ritesh. You can just have a look.
Okay, 1 second. I cannot see.
So I'll just read it for you. So he's asking, if we purchase gold ETF or gold mutual fund versus physical gold, GST charge is different or not? So he's asking about the GST charges in different gold investments.
Yes. See, like I mentioned, if you're investing into gold ETF or you are investing into gold mutual fund, there is no GST there. So GST is nil. You don't have to pay any GST if you're investing into gold ETF or gold mutual fund. But in physical gold, you need to pay GST, which is at 3%. Even if you're going for, in physical gold, you're going for jewelry and all, then on making charges also, there will be GST that will be levied. So 3% is the GST for physical gold. In other two options that you asked, there is no GST. So thank you so much. I guess with this, we have answered all the questions, and thank you so much for your time. Thank you, Nawaz.
Yeah, I just want to make one special announcement. And before that, I would just like to thank Nidhi for making us an informed investor in terms of investing in gold. And since it's already in the news that big companies like Meta, Twitter, Google are laying off their employees on a mass level, and it's not only limited globally, Indian companies have started it too. So on 8th of December, we'll be doing a special webinar, and in which we'll tell you how you can protect your downside, not from adversities like layoffs, but from some such other adversities too. So stay tuned for our further updates. We will share the webinar link to you all over the mail. And thank you once again for attending the webinar. Hope to see you soon. Thank you so much.
Thank you. Thank you, everyone.